Hey guys, thanks for tuning in, and I hope you've subscribed to the channel by now. Right here, I'm going to talk about a very special mortgage product that's making a big comeback with rates surging up towards 7% or even higher recently. The purpose of this loan is that it's going to initially offset a high monthly payment. And it's really going to help not only the buyer, but also the seller and the listing agent. And I'll tell you that by the end. How? This is called the 1021 or 321 interest buy down. So the way it works is that either the buyer or the seller can prepay a portion of the buyer's interest for the first year, 2, or 3. Okay, so for example, let's say the starting interest rate is 7.5%. Well, if it's only done for the first year, then the interest rate is lowered by 1% for the first year, and that amount that you have to lower the payments by is prepaid. So if the mortgage loan amount is equal to roughly $647,000, then approximately $5,200 is going to be prepaid to make the monthly payments equivalent to an interest rate that's 1% lower than the starting interest rate of 7.5%. So you get like a 6.5% interest rate for the first year. Now, if it's done for the first 2 years, then the interest rate is lowered by 2% for the first year and 1% for the second year. Okay, so with the same loan amount of $647,200, roughly $10,000 and change is paid up front for year 1, and roughly $5,000 and change is prepaid for year 2. That would total in this case about $15,000 and change. So that for year 1, you're making payments equivalent to an interest rate that's 2% lower, or 5.5% in the first year. And then for year 2, you're making payments equivalent to a 1% lower rate, or 6.5%. So if you understand how those first two work, then you'll definitely understand how a 3-2-1 buy down works. But this is available with many lenders for the basic conventional VA, FHA, conforming 30-year fixed products. Not so much for the ARMs, the adjustable rate mortgages, even though those adjustable rate mortgages are very difficult to price out right now. But when rates were low, this interest rate buy down was not such a big deal. But now that they're higher, everybody wants to request about when all the cool kids are doing it. But what's really important about this is that the money that you're prepaying interest for goes into an escrow account. Okay, so if you get out of the loan for any reason, you refinance, sell, move, you get any unused prepaid interest money back. Okay, so if you instead paid points or extra closing costs, which is your other alternative to lower the interest rate up front for the first couple of years to reduce the interest rate, and you got out of the loan in a few years, you sold or refinanced or moved, then those extra thousands of dollars of points that you paid at closing would then have only lowered the interest rate for a short time and won't have made any mathematical sense. Okay, because for paying points to make sense, you have to stay in that loan for a long time. Okay, so let's say you paid $5,000 in points at closing to lower the rate by $100. You have to then be in that loan for $5,000 divided by $100. That's 50 months for those points to make sense. So if you're only in the loan for 20 months, then those points you paid, 20 months times $100 in savings, only saved you $2,000. But you paid $5,000, so there was a $3,000 difference of a waste there with the points. Okay, so that point waste won't happen with this buy down. Another point about this is that it really helps the listing agent and the sellers because it allows them to keep the sales price a little higher. You don't want any bad publicity as a seller. If you reduce your home sales price on those home search websites, people are going to think that there's something wrong with the house. You don't want that bad pub. And also, if you're a listing agent, then your list to sale price ratio stays high. Also, one more thing, the interested party contribution limit applies. If the seller is going to pay a big chunk of closing costs in the form of this interest buy down, and the down payment is less than 10%, then the lender on the conventional conforming loan won't let the seller contribute more than 3% of the purchase price in closing costs to the buyer. So sometimes you can be restrained if you ask for enough money from the sellers. But if you were gonna have a VA or FHA loan, they wouldn't have those strict limits like that. But that's about it. And if you have a friend who's antsy about making a high initial payment, then make sure you send this to them. And thank you very much for watching.